Today, we're going to talk about the most important skill in investing, a skill that is more important than mathematics, more important than an economics degree, more important than connections on Wall Street. We're going to talk about emotional control, and if you think this is some kind of psychological nonsense, let me tell you straight. In 70 years of investing, I've seen thousands of smart people go broke, not because they were stupid, but because they couldn't control their emotions. Success with money hinges more on emotional discipline than IQ panic, selling, and greed ruin investments. Mastering emotions lets you buy low, hold long, and build lasting wealth with less stress. Today, I am going to tell you exactly how to do it. Let me start with a story that perfectly illustrates this problem. In March 2020, when the pandemic first hit, the market dropped 34%. In 3 weeks, 34%. If you had $1 million in stocks, you woke up looking at 660,000 every day. You turned on the television. You heard about new deaths, closed businesses, and approaching depression. What did most investors do? They sold, they panicked and sold at the very bottom of the market. They turned temporary paper losses into real permanent losses. And what happened next? The market recovered in 5 months, and by the end of 2020 reached new highs. By the end of 2021, it was up another 28%. Those who sold in panic in March 2020 missed one of the greatest growth periods in market history. But those who controlled their emotions, who held on, or better yet bought when others panicked, doubled their wealth in 2 years. This wasn't a question of intelligence. The people who panic sold weren't stupid. Many of them were doctors, lawyers, engineers, people with IQs significantly above average. But in the moment of fear, their emotions defeated their reason, and it cost them hundreds of thousands, in some cases millions of dollars. I often say that investing is simple but not easy. Simple because the rules are clear: buy good companies at reasonable prices and hold them for a long time. Not easy because it requires emotional control that most people don't have. Let me explain the mathematics of emotions. Because in investing, if you can't calculate the consequences of your decisions, you shouldn't be making those decisions at all. Imagine you invested $100,000 in the S&P 500 index on January 1st, 1980. If you had simply held those stocks until the end of 2024, doing nothing, not even checking their value every day, your $100,000 would have turned into more than $11 million. $11 million from 110 times over 45 years. Average annual return of about 11%. But here's what is interesting. A study by Dalbar showed that the average stock investor over that same period earned only about 4% annually. 4% instead of 11. Why such a huge difference? Not because people chose bad stocks, not because they paid too much in fees. The difference was emotional decisions. People bought when the market was rising and everyone was talking about easy money. They sold when the market was falling and everyone was talking about impending collapse. They did exactly the opposite of what needed to be done. If those people had simply held their investments and not let emotions dictate their decisions, the difference in their wealth would have been astronomical. $100,000 at 4% annually for 45 years becomes $594,000 at 11%. 11 million. Emotional decisions cost the average investor more than $10 million. $10 million lost, not on bad companies, not on scammers, not on complex derivatives. Lost simply because people couldn't control their fear and their greed. Now let's talk about the two main emotional enemies of investors, fear and greed. These two emotions have destroyed more investment portfolios than all market crashes in history combined. Fear makes you sell at the worst time. When the market drops 10%, your brain starts painting catastrophic scenarios. What if this is the beginning of a new Great Depression? What if the market falls another 50%? What if I lose everything? And the more the market falls, the stronger the fear becomes, until one day you can't take it anymore and you sell everything. The problem is that by the time fear becomes unbearable, the market has usually already reached or is close to reaching bottom. You sell at the worst possible moment, lock in huge losses, and then watch from the sidelines as the market recovers without you. Greed is no less destructive, it just works in the opposite direction. Greed makes you buy at market peaks when prices are maximally inflated. When everyone around is talking about easy money, when your neighbor brags that he doubled his money on shares of some tech company nobody's heard of, when even the cab driver is giving you stock tips, that is a sign that greed has reached dangerous levels. Greed also makes you hold positions too long. You buy a stock at $50, it grows to 100, and you think it'll reach 200. Then it falls to 70, and you tell yourself you'll wait until it gets back to 100. Then it falls to 40, and you are still holding, hoping for recovery. You turned a profit into a loss simply because greed wouldn't let you lock in a reasonable gain. I've seen this again and again in the late 1990s during the dot-com bubble. People were buying shares of companies with no profits, no revenue, sometimes not even a real product, at astronomical prices. Why greed? They saw others getting rich and wanted the same. When the bubble burst in 2000, the NASDAQ index fell 78%. 78%. People lost their savings, their pensions, their homes. But here is what is interesting. If you ask those people today what went wrong, most will say the market was unpredictable, that it was an unforeseen catastrophe. They won't admit that the problem was themselves, their inability to control greed. Let me tell you about how I learned to control emotions, because I wasn't born with this skill. My first important lesson came in 1987, on Black Monday. On October 19, 1987, the market fell 22% in one day. 22% in one day. It remains the largest single-day percentage drop in market history. That day, Berkshire Hathaway's value dropped $342 million, $342 million in one day. You know what I did? Nothing. I came to work, read financial reports as usual, and went home. I didn't sell a single share. I didn't panic. I didn't lose sleep. Why? Because I understood a fundamental truth. The value of a business doesn't change 22% in one day. Coca-Cola didn't get worse at making beverages. The Washington Post didn't get worse at publishing news. Their businesses remained as good as they were the day before. Only prices changed, and prices in the short term reflect emotions, not value. 2 years later, the market not only recovered, but reached new highs. Those who sold in panic on Black Monday lost enormous amounts of money. Those who held on or bought prospered. That experience taught me the most important rule of emotional control: never make investment decisions based on short-term price movements. Price is what you pay, value is what you get. And in the short term, price and value can diverge wildly. Now, let me give you specific strategies for mastering emotional control, because understanding the problem is only the first step. You need practical tools to deal with emotions in real situations. First strategy, invest only money you won't need for at least 5 years, preferably 10. This is the most important rule of emotional control, because most emotional decisions come from fear that you'll need this money soon. If you invested money you'll need in a year for a down payment on a house, you won't be able to control emotions when the market drops 20%. You'll have to sell because you need the money. But if you don't need that money for 10 years, a 20% drop is just noise, a temporary fluctuation you can ignore. I have a simple rule: keep enough cash or short-term bonds to cover all your expenses for 5 years. If something happens with your job, if an emergency arises, if the market drops and stays down for years, you have a safety cushion. That reserve gives you the emotional strength to hold your stocks through any storm. Second strategy, never check your portfolio every day. I know this sounds strange in an era when everyone can see their portfolio value in real time on their phone, but that is exactly the problem. The more often you look at prices, the more likely you are to make an emotional decision. Here is the math that explains why. The stock market goes up about 53% of days and down 47% of days. If you check your portfolio every day, 47% of the time you'll see losses. That means almost half the time you are getting negative information that activates the emotion of fear. But here is what is interesting. If you look at the market not daily but annually, it rises about 73% of years. If you look at 10-year periods, the market has been positive 94% of all decades since 1926. The longer your time horizon, the more positive results you see and the less fear you experience. I check Berkshire Hathaway's value maybe once a month, sometimes less. I don't need to know the price every day because I am not going to sell. The price on any particular day doesn't matter to a long-term investor. Third strategy, develop a system and stick to it mechanically, regardless of what you feel. Emotions are the enemy when they guide your decisions, but a system is your friend because it makes decisions for you. For example, you might decide to invest a certain amount every month, regardless of what the market is doing. This is called dollar cost averaging. When the market is high, you buy fewer shares. When the market is low, you buy more shares over many years. You automatically buy more at low prices, which is exactly what you want to do. The beauty of this system is that it removes emotions from the process. You don't have to decide whether it is time to buy or sell. You just follow the system. The market dropped 10%. Doesn't matter. You buy as planned. The market rose 20%. Doesn't matter. You buy as planned. AD Berkshire Hathaway, we use a different system, but the principle is the same. We buy businesses when they're trading significantly below their intrinsic value, and we hold them as long as they remain good businesses at reasonable prices. Emotions don't enter the equation. Only math and discipline, fourth strategy. Learn from history, because the market repeats itself emotionally, even if specific circumstances are different. Every market crash in history seemed unique and frightening to people living through it. The Great Depression, Black Monday, 1987, the dot-com bubble, the 2008 financial crisis, the 2020 pandemic. Every time, people said this time is different, that the world had fundamentally changed, that the old rules no longer work, and every single time, without exception, the market recovered and reached new highs. If you study these periods, you'll notice a pattern. The maximum pain, when fear is greatest and most people sell, almost always marks the bottom. In 2008, when Lehman Brothers collapsed and the entire financial system seemed on the verge of collapse, the S&P 500 fell to 666 points. In March 2009. Everyone was convinced we were entering another Great Depression. Bank of America was trading at $3 per share, General Electric at $6, American Express at $10. What did I do? I wrote an op-ed in the New York Times titled, "Buy American, I Am." I said that by the time the economy recovers, stocks will have already recovered, perhaps by a lot. You want to be buying when pessimism is peak, not when optimism has returned. People thought I was crazy, but by the end of 2009, the market was up 65% from the bottom. By 2013, it had more than doubled. Those who sold in panic in March 2009 missed one of the greatest bull markets in history. Those who bought when everyone else was terrified made fortunes. The lesson from history is clear. Crashes are temporary. Recovery is permanent. Since 1926, the U.S. stock market has experienced 15 recessions, 2 world wars, the Great Depression, the Cold War, multiple oil crises, 9/11s, the financial crisis, and a global pandemic. Through all of that, the market has grown from 100 points to over 6,000 points today. That is 60 times, not counting dividends. Every time someone panicked and sold, they lost. Every time someone stayed calm and held on or bought, they won. It is not about intelligence. It is about emotional discipline. Fifth strategy, understand the difference between risk and volatility. Most people think these are the same thing, but they're not. Volatility is when prices go up and down. Risk is the permanent loss of capital. When the market drops 20%, that is volatility, not risk. The risk only materializes if you sell at the bottom and lock in the loss. If you hold good companies through the volatility, you'll be fine. In fact, volatility creates opportunity for those with emotional control to buy at lower prices. I never worry about volatility. Berkshire's stock price has fallen more than 50% on multiple occasions. In 1974, it fell from $90 to $40. In 2008, it fell from $150,000 to $70,000 per S-hair. Did I panic? Did I sell? Of course not. The businesses we owned didn't become less valuable just because the stock price fell. The real risk in investing isn't volatility. It is buying a bad business at any price. It is overpaying for even a good business. It is using borrowed money that you might need to repay at the worst possible time. It is letting fear or greed make your decisions for you. Sixth strategy, focus on what you can control. You can't control whether the market goes up or down tomorrow. You can't control whether we enter a recession next year. You can't control what other investors do, but you can control several critical things. You can control which companies you invest in, choose businesses you understand with strong competitive advantages, run by honest and capable management, selling at reasonable prices. You can control how much you pay, never overpay, even for a great business. You can control your time horizon, give your investments time to compound. You can control your emotions. This is the hardest but most important thing you can control. When you focus on what you can control, you worry less about what you can't. The market will do what it does. Your job is to make smart decisions and stick with them. Seventh strategy, keep a journal of your investment decisions. Write down why you are buying a stock, what price you are paying, what you expect the business to do over the next 5 to 10 years. Then periodically review your journal. This practice does several things. First, it forces you to think clearly about your decisions before making them. You can't write, "I am buying because everyone says it is going up." You have to articulate a real investment thesis. When you look back at your decisions, you'll see patterns. Maybe you always buy when you are feeling euphoric, and the market is high. Maybe you always sell when you are scared, and the market is low. Recognizing these patterns is the first step to changing them. Third, it helps you learn from both successes and failures. When an investment works out, you can look back and see what you got right. When it doesn't, you can see what you missed. Over time, you'll become a better investor by learning from your own experience. Eighth strategy, remember that doing nothing is often the best action. In investing, activity is not correlated with results. In fact, the most active investors usually have the worst results because every trade is an opportunity to make an emotional mistake. At Berkshire, our favorite holding period is forever. When we buy a business, we're not thinking about when we'll sell it, we're thinking about owning it for decades. This approach has served us extraordinarily well. Some of our best investments are ones we bought 30, 40, even 50 years ago and never sold. Coca-Cola, which we bought mostly in 1988, has been in our portfolio for 37 years. American Express, which we first bought in the 1960s, has been with us even longer. We've held through multiple recessions, multiple market crashes, countless periods of pessimism, and our patience has been rewarded handsomely. Compare this to the average investor who checks their portfolio daily, makes dozens of trades per year, constantly trying to time the market or find the next hot stock. All that activity generates fees, taxes, and emotional stress, and almost always it produces worse results than simply buying good businesses and doing nothing. Ninth strategy, build a margin of safety into every investment. This is a concept my mentor, Ben Graham, taught me, and it is one of the most important protections against emotional mistakes. The margin of safety means buying at a price significantly below what you calculate the business is worth. If you calculate a business is worth $100 per S-hair, don't buy it at 98, buy it at 60 or 70. That 30 to 40% discount is your margin of safety. It protects you in two ways. First, if your analysis is wrong and the business is only worth 80 instead of 100, you still make money. Second, and more importantly for emotional control, it gives you confidence to hold through downturns. When the market crashes and your stock falls, if you bought with a large margin of safety, you got a good deal. The lower price just makes it an even better deal. You are not worried because the value is there. But if you paid full price or too much, every drop is terrifying because you don't have that cushion. 10th strategy, Surround yourself with the right influences. If you watch CNBC all day, with commentators screaming about every market move, you'll become emotional. If you follow dozens of traders on social media promising quick profits, you'll become greedy. If you read apocalyptic financial blogs predicting the end of capitalism, you'll become fearful. I don't watch financial television. I don't follow market commentators on social media. I don't read newsletters promising to reveal the next Amazon. These sources exist to generate emotional reactions that keep you watching, clicking, and trading. They're designed to make you emotional, not to make you wealthy. Instead, I read annual reports. I read business books. I read about economic history. I surround myself with rational, long-term thinkers. My late partner, Charlie Munger, was the best example for nearly 60 years. Charlie and I reinforced each other's rationality. When one of us was tempted to make an emotional decision, the other provided perspective. Find your own Charlie, whether that is a spouse, a friend, or a community of like-minded investors. Have someone you trust who can talk you off the ledge when you are tempted to sell in a panic or buy in a frenzy. Let me tell you about the real secret to emotional control. The one thing that matters more than all the strategies I've given you, it is this. You must genuinely understand and believe that wealth is built slowly over decades, not quickly in months or years. Once you truly internalize this truth, emotional control becomes much easier. The problem is that most people don't really believe this. Intellectually, they might agree, but emotionally, they're still looking for the shortcut, the quick win, the 10-bagger that will make them rich in 2 years. And that emotional desire for quick wealth makes them vulnerable to every market swing, every hot tip, every moment of fear or greed. I started investing when I was 11 years old. I am now 94, that is 83 years of investing. My wealth didn't come from brilliant stock picks or perfect market timing. It came from compound interest working over 8 decades. 99% of my net worth was built after I turned 50. Most of it was built after I turned 60. Think about that. If I had started investing at 30 instead of 11, I'd still be enormously wealthy. If I had started at 40, I'd still be very wealthy. The key wasn't starting young. Though that helped, the key was staying in the game for a very long time and not making emotional mistakes that forced me out. This is the perspective you need to develop. Your goal isn't to get rich next year. It is to still be investing and compounding 40 years from now. And the only way to do that is to avoid the emotional mistakes that wipe people out. Now, I want to address a question some of you are probably thinking, what if you are right and I control my emotions and hold through a downturn? But this time really is different. What if this is the one crash the market doesn't recover from? It is a fair question, and the honest answer is that anything is possible. But consider this. Betting that America's economy and innovative capacity will continue to grow over time has been the right bet for 250 years. Betting against it has always been wrong, always. Could that change? Could we enter a permanent decline where stocks never recover? I suppose it is possible. But if that happens, if the American economy truly collapses permanently, your stock portfolio will be the least of your worries. In that scenario, everything is worthless. Cash, bonds, gold, real estate, everything. So you are really betting on one of two outcomes. Either the American economy continues to grow as it has for 2.5 centuries, in which case owning businesses is the best path to wealth, or it collapses permanently, in which case nothing matters anyway. Those are your choices, and historically, betting on continued growth has won every single time. This is why I remain optimistic. Not because I am naive or don't see the problems, but because the alternative to optimism is either paralysis or betting on catastrophe. Neither of those is a winning strategy. Let me bring this all together with a simple framework you can use. When you are feeling emotional about an investment, ask yourself 3 questions. First, has the fundamental quality of the business changed? If you own shares in a great company with strong competitive advantages, honest management, and good economics, and the stock price falls, but nothing about the business has changed, then the drop is just noise. Ignore it. Second, is my original investment thesis still valid? If you bought a stock because you believed the business would grow earnings at 10% annually for the next decade, and nothing has happened to change that belief, then hold on. The market's opinion of what the stock should be worth today doesn't matter. What matters is whether your long-term thesis is still intact. Third, if I didn't own this stock today, would I buy it at the current price? This is a powerful question because it removes the emotional attachment to your original purchase price. Maybe you bought at 50 and it is now at 30. You are down 40% and you feel sick, but forget what you paid. If the business is worth 100 and it is trading at 30, you should be buying more, not selling. Your original purchase price is irrelevant. Only the current price versus value matters. These three questions can cut through almost any emotional fog. They force you to think rationally about value instead of reacting emotionally to price movements. Before I close, let me give you one final piece of advice. Be patient with yourself. Emotional control is a skill that develops over time. You will make mistakes. You will panic and sell at the wrong time. You will get greedy and buy at the wrong time. I've made these mistakes. Every successful investor has made these mistakes. The difference between successful and unsuccessful investors isn't that successful investors never make emotional mistakes. It is that successful investors learn from those mistakes, forgive themselves, and develop better discipline over time. Each mistake is tuition paid to the school of investing. Make sure you are learning from that tuition. Start small if you need to. If you are not confident in your emotional control, don't invest your entire net worth. Start with an amount you can afford to watch fluctuate without losing sleep. As you gain experience and confidence, as you live through a few market cycles, and realize you survived, you can gradually increase your exposure. The goal is to build your wealth and your emotional discipline simultaneously. They reinforce each other. The more disciplined you become, the more wealth you build. The more wealth you build, the more confidence you have in your discipline. Success with money truly hinges more on emotional discipline than IQ. I've seen brilliant people fail as investors and ordinary people succeed. The difference wasn't intelligence. It was the ability to control fear and greed. It was the patience to buy low, hold long, and build wealth over decades. It was the wisdom to know that in investing, doing the simple thing consistently beats doing the clever thing erratically. Master your emotions, and you won't just build wealth, you'll build peace of mind, you'll sleep better, you'll stress less, you'll enjoy life more, because you'll know that while others are panicking about every market move, you are quietly building a fortune through patience, discipline, and emotional control. That is the real secret to a winning money mindset.